Hey, we made it. For some reason, it didn't let me in. Not sure exactly what was the problem, but
No worries. I've had problems before, so probably not you. Okay, so first off, you're not from the US, right? You're in Europe?
yeah, correct. From my accent as well, you're probably
Oh yeah.
getting that already.
Where in Europe are you?
In the Netherlands, actually between
Oh,
the
okay.
Netherlands and Italy, I travel across countries.
So I tried to get Alf as one of our speakers for the FinTwit conference in May, and then he told me that it's just too much of a hassle to travel over from Europe to Vegas, for a couple days, which I get. So, but I respect him. I've been following him on Twitter for the past couple months. He writes a newsletter, and he's basically like become a macro thought leader on Twitter. So just jump in, give us a little heads up on what's your background. I mentioned in the email blast that you used to run a $20 billion fund. Can you tell us more about that?
Yeah, sure. So it would be my pleasure to be on the next FinTwit conference. It's just that it was a bit short notice, and for me to travel across the ocean is a bit complicated.
And
But it's
expensive.
going to be.
I can't even imagine what the flights cost right now to go from Europe to Vegas. Probably a couple $1,000.
Yeah, I guess so. Let's not even get there. But it's a pleasure to be here and have a chat with you. Yes, I used to run a $20 billion portfolio until 4 months ago, till I quit. So that was for a large European bank, a listed bank in Europe. And basically, I started a career there 8 years ago, 7 to 8 years ago, as a portfolio manager, and then worked up my way to lead a team and manage a larger portfolio, and having some portfolio managers reporting to me, etc. It was a rewarding experience, learning a lot very fast and getting exposed to a lot of these, investment banks and smart guys out there, strategists, traders, hedge fund managers, but also politicians like G10 prime ministers that I met at conferences, or central bankers. It was a really rewarding experience, especially if you live it, willing to learn about how different people have different incentive schemes and they think about different topics in a different way, rather than close yourself in an echo chamber, till to the point where it became less fascinating, I think. And I was more looking into building something on my own, and I decided to just quit and start basically producing content for the broader audience. Because one of the problems is that when you run a fund like the one I run, effectively the company, I guess, for good reason, wants you to keep your knowledge inside the company, and it never actually fit my personality. I just want to share, and make sure that I can share this learning journey with you guys, the knowledge I've accumulated over the years, but also continue to learn and put out my thoughts in a way that more people can benefit from it.
Gotcha. So what was your role on the team? I mean, you're obviously big into macro. Was that your responsibility? Were you kind of the macro strategist?
I was the head of this investment portfolio of 20 billion, where we were running mostly, it was a macro investment portfolio, mostly focused on fixed income, especially rates, but also credits. So we also traded some investment grade or high yield junk credit spreads, credit products, let's say. Also structured products, and then we did equities as well at the end of the mandate. So mostly fixed income, one can say around 80-85%, but also some credits and some equities in there. And the portfolio was really global. So we had, different currencies, also emerging market currencies in there, Turkey, Russia, and what have you. So it was a pretty interesting portfolio to run until a certain point where the mandate becomes, pretty constricted, and you would maybe want to do something else, as I described before.
So for anyone that's watching this afterwards, because I'm going to post it on YouTube and then blast it out on Twitter, how would you define macro? What does it include?
It's a good question. Actually, it's easier to define what is not included in macro. It's much easier. And so what's not included in macro is bottom-up single stock selection process. So that's not included in macro. For instance, if you want to say, I want to be long Twitter, short Facebook as a relative value trade within the same sector, single stock, that's not macro. That's a different game. And also what's not macro is trend following strategies, momentum strategies, and all, more technical, trendy sort of strategies, momentum strategies. Those are not macro.
I mean, even specific company fundamentals is not considered macro, right?
That is correct. So single company risk and strategies that are not considering as input macroeconomic indicators. Those are not macro, and one can say that everything else is macro. I'm just kidding, but I'm generalizing now, but you get what I want to say.
And right now it feels like fundamentals don't matter as much as the macro. It's all the macro stuff that's really moving the markets, especially the last couple of days with, the Fed speak and the FOMC minutes coming out today, and obviously commodity prices and inflation. And, that's what we're going to talk about. So when you wake up in the morning, and I know you're in the Netherlands, so the time difference is kind of ridiculous. You probably go to bed very early and wake up, or go to bed very early and then wake up very early.
Sure.
But when you wake up in the morning, what are you looking at first? What do you care about the most?
Yeah, so basically I have a dashboard, a macro dashboard that flashes to me if something has gone bonkers overnight, which means that the first thing I look at, Jonah, is markets. So price always is my first indication to understand what's going on and why. So what I did is I built a global macro dashboard that basically is color-coded and tells me if something has moved very aggressively compared to the average implied move in that market. So of course, for euro dollar, which is an FX pair, which is very stable, that's going to be, well, 1% move is a large move. For Bitcoin, a 1% move is not a large move. So obviously you have to, adjust it for the realized and implied volatility. And if something is moving a lot, that would be my first indicator to go and check my positions that I'm running. So how have they been affected by this move? And then second, what is the underlying reason behind these moves? Then you start scrolling the news and you already enter with a bias, of course, into that consideration. So you have a sort of set of information in your head, and then you have this price action in front of you. You receive the input, you check how your positions have been affected, and then you dig into what are the macro underlying reasons why that move has happened. And then you go through the news and you start to incorporate new information into your process. And my macro process is also, it's a mix of systematic macro data-based process, but also discretionary process, which means that I design a model where we are in a certain quadrant or in a certain macro regime, and according to data that I collect and analyze. And then in that macro regime, certain asset classes are supposed to behave in a certain way. So you backtest them, you see that it works in that regime, and it should trade like that. If they trade differently and there's a very sharp move against your base case scenario, then at that point, you might want to start digging into why is that? Should I fade it, or something, particular is happening? And at that point, you have a discretionary macro overlay. After all the systematic approach, you have a discretionary macro overlay that basically comes from your understanding of how the macro dots are connected with each other. And, the monetary system is very complex. You start from different tiers of money. So one is the central bank balance sheet. The other one is the money we can really spend in the real economy. So that's credit. You start from these building blocks and you build it up through the structure to understand how balance sheets work in the private sector, in the public sector, what is moving. If a central bank is applying a monetary policy which is different than another, what does it mean? And you incorporate all these considerations into your final decision process. And the most important thing is you make sure that the risks are limited in the trades you make, because at the end of the day, what you're looking for in a macro investment portfolio is for few trades that make a lot of money, while the remaining trades can be range bound. But as long as you get those two right, very right, and then you limit the losses on the bad decisions you're going to make, at the end of the year, you're going to be profitable.
What have been some of your best trades this year so far? Or how is your portfolio positioned right now?
So I just closed, I'm going to beat my chest now, but I just closed a very good trade. It's a 4 standard deviation trade, which rarely happen. I think if you I don't know the percentage top of my head, but it's probably in the low single digit.
I'm going to guess it was either long natural gas or short long bonds or something.
Very good. That was it. So I shorted 2-year treasuries by a future, and I bought 10-year treasuries again by a future against it. So it was a curvature trade. Okay. The only thing I cared about is that the curve had to become flatter. So I'd made an analysis looking at how the Fed had moved and looking at different, similar macro regimes at the beginning of the year. And I realized that we basically were trading a somewhere similar regime to 2018, mid of 2018, where the Federal Reserve was getting more and more aggressive. If you remember, they were hiking, they were doing QT, but the economy was, it was still growing, but the pace of growth was sort of slowing down. because the last fiscal stimulus we had back then was in 2017. And so, all this buoyant sentiment was a bit fading away, but the Federal Reserve was very committed in hiking, and tightening monetary policy. And then the curve tends to flatten in this environment. So I put it on. Of course, when I put it on, I didn't expect to have a 4 standard deviation performance. I mean, everybody hopes to have such profitable trades. But again, because of my systematic approach to sizing the position and then taking profits or stop losses according to a system, I was able to basically make the profits run. So when I hit the first target, I then move it to a second target and I adjust the stop loss in a trading fashion. If it continues moving my way, I just never take profit basically until I get a sharp retracement against my position. And then at that point, I'm going to say, okay, fair enough. Maybe the narrative's changing. The macro performance I expect is not going to be the same anymore. But as long as the trend is going my way and there are no sharp repricing in this trend against me, I'm going to keep the position running. And I run basically until the curve inverted in 2-year versus 10-year, which happened last week.
Is that why you close it out? Because once it inverted, you're basically the best case scenario played out for you?
Not really, I have to say. I mean, that's one consideration, but once the position is on, John, and I have the macro set up in my head, it's rather a system that decides for me when I should exit the position. And that means that because the trailing profit targets were moving lower and lower, the position was working on my way. So it was basically the trailing profit targets were moving higher, higher, and higher in P&L, but in flatness of the curve, flatter, 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 flatter. We reached the point where the next profit target was minus 10 basis point, basically flatter. And then the next stop loss, which is a large profit taking in reality, ended up being 5 basis point positive. So what the curve did is it went all the way down to -8 or -9, and then it bounced back to +5. And there my model tell me, wow, that's a 13 basis point move against you in few days. It means probably the macro narrative is changing, the traders move long enough, you can take profits. Gotcha. But if the curve would have continued to invert to -100 basis point, I would have continued to run the trade under my model, systematic model, because that's how you generate these large outlier profits. You basically make your profits run as long as there is no major sharp movement against you. You should make your profits run. What you should cut short are your losses, obviously.
So what do you think right now about the yield curve? I mean, obviously it inverted a few days ago, and then then it spread out a little bit. It's pretty flat right now. I mean, I looked about an hour ago, and rates have been ripping higher the last week or two. I think we got up to 2.6 or 2.65 today on the 10. I forget right now, but what are your thoughts going forward?
So I think the yield curve will structurally remain very flat in this environment. And the reason is very simple. We have a Federal Reserve, which is basically has elected inflation as enemy number 1, 2, 3, 4, 5. There is no other thing that matters at the moment. They really want to get a grip on that. And they want to make sure that the market understands how serious they are. And Jonah, let's be honest. I mean, these inflationary pressures are coming as a combination of the huge fiscal stimulus that was driven through the economy in 2021. But now this fiscal stimulus is fading away. Where is the last time that Americans received the checks in their post box? It's March 2021.
Now it's all about the supply side, right?
Correct. But still, if you're the central bank and you see inflation at 7.5%, wow, you got to do something, especially because inflation expectations are now becoming also a bit younger on the upside. I did some analysis on inflation swaps, and I looked at the probability distribution of these inflation swaps. So inflation swaps are products traded in the market where basically traders agree on what will be the average inflation over the next 5 years, and they exchange a product based on this underlying assumption. 5-year inflation in the US by traders is expected to be around 3.5%.
So would that be like that's where the Fed wants to get the Fed funds rate, probably, right? As close to that as possible.
They want to get it to a point where people start to believe that inflation over the next 5 years will not be 3.5% anymore. So they want to push this Fed funds rate to a point where investors are like, wow, if they go that high in terms of nominal interest rates, inflation has to slow down, right? At the moment, inflation expectations are 3.5% for the next 5 years. The Fed target is 2%, not 3.5%. Right. And especially if you look at this distribution, The mean is 3.5%, the average expected outcome. But the tail of the distribution, especially the right tail, the one where inflation can be 5, 6, or 7%, is becoming fatter. So if you're Powell, you're like, 3.5% is already quite a high expected inflation over the next 5 years. My target is 2%.
Just people know what's been the average inflation rate over the last 10 or 20 years? It's like 2%, right?
Yeah. So the average core inflation in America over the last 15 years has been below 2%, around about 1.8, 1.9%. And now traders are telling you, Jonah, I expect it to be 3.5% over the next 5 years. And the Fed is like, whoa, that's too much. Also, they're telling you that they expect a certain probability, non-negligible probability, that this inflation can be 5%. So if you're Powell, you're like, no, that doesn't work. I don't want that. I don't want these expectations being rooted in your head, because then otherwise you as a consumer will start doing things that can, kickstart an inflationary loop, and we don't want that. So they need to send you a strong signal. And how do they do that? They basically tell you, I can't do anything about supply. I mean, the Federal Reserve can't get the ships of wheat and corn that are stuck in Ukraine. And
the ports are a disaster. I mean, I think shipping's a mess. I think trucking's getting a little bit better from what I've heard. But if you still can't get stuff off the ships, what does it matter how many trucks you have?
I mean, if Shanghai port is closed, right, and if China says, I'm sorry, but nobody's getting in and out, and if the corn silos in Ukraine are filled with corn that normally would get exported, but it can't get exported, and food's going to get more expensive.
And fertilizer prices are up like 200, 300% year over year.
And Jonah, the Fed can't do anything about that. They can't do anything about it. So, but what can they do about inflation is to slow down demand.
Right.
They can say, okay, if supply is stuck, I can't do much about it. I can do something about demand, especially as demand went through the roof through the fiscal stimulus. Well, I think you guys can take a hit there. And what they're doing for slowing down demand is to make sure whether when you go and want to borrow, Jonah, you find your mortgage rates that have moved from 3% to 5%. And then you think twice about borrowing to buy a more expensive house because borrowing rates have gone up, right? So
how much of slowing down demand is knowing, we all know this because we've seen it, when the Fed hikes rates, stock markets or, equities, long dated assets, typically, they pull back. I mean, sometimes 5%, sometimes 10, 20%. I mean, depends on so much other data and the earnings and the outlook and whatnot. But I mean, there's the wealth effect, right? I mean, and Powell knows if the market goes down, if risk assets pull back, we all feel a little less wealthy. We start to tighten up our purse strings and wallets and spending. And then that's sort of what fixes the demand. So is it more about he's willing to let the market and risk assets pull back?
Yes. I mean, he was very explicit. And Bill Dudley, which was a former FOMC member, came up with an op-ed on the Financial Times yesterday, highlighting something I've been saying for a couple of months. Have you listened to Jerome Powell? He went out on press conferences and he said, financial conditions have to tighten, which literally means if you look at how the financial condition index is built, this is inflation-adjusted interest rates, credit spreads, and equity prices. Mostly that's it. And so real interest rates, they have to go up to make tighter financial conditions, which means that either inflation expectations have to slow down. As we discussed, they are already much above the Fed target. He doesn't like that. And or in combination, nominal interest rates have to go up, which is what he's trying to do by hiking interest rates, right? He hopes to hike nominal rates and to slow down inflation expectations. And so he will achieve that part. The market is reacting to that, right? I mean, nominal interest rates, as you discussed, are going up. Inflation expectation, not moving yet. The second thing is equity prices, and those are reacting. You see equity markets are a bit wobbly since the beginning of the year. The third thing is credit.
Since November, when he basically said that inflation is not transitory and, it's time to get a little bit more aggressive.
Yeah, then he turned, and then in December, he told you financial conditions have to tighten. And then they asked him a question like, they have tightened a bit. And he's like, what are you talking about? It's a blip in an ocean. They're extremely loose. People can still borrow at very cheap rates. they still have this wealth effect where their 401ks have gone through the roof. And so they feel like they can spend more. Their house prices are, they maybe own a house. And so they have this wealth effect, and he wants to slow that down. He doesn't want to crash the market. So don't get me wrong. He understands that the wealth effect is paramount important in our system, and is so rooted in the way our system works and generates wealth, basically, that he doesn't want to get that affected that much. But he wants a temporary slowdown of that wealth effect, which basically in translation means he wants wider credit spreads, higher mortgage rates, higher interest rates, and lower equity prices. This is and a higher dollar as well. That's the way that you basically tighten financial conditions. And he's not going to slow down unless he sees the key driver, which is inflation expectations, start to go down a bit. That's what he wants to see. He wants to see people understanding that he's serious, he's going to tighten. So your expectation about inflation has to come down as well. When he achieves that, then maybe things are going to calm down.
Now, consumer balance sheets are still relatively strong, partly because during the pandemic, nobody was spending money. So you were paying off your debt while you're getting stimulus checks from the government. Now we're out spending money. Travel is out of control. Hotel prices are ripping higher. Airfares are going higher. Mortgage rates have basically doubled over the last year. I mean, a 30-year mortgage is now at 5%. So the refi business has been absolutely destroyed. At what point do you think the housing market, I don't think we were in a bubble necessarily, but there was still some pretty stupid activity over the last couple of years when rates got that low. It obviously sent prices through the roof. People were, I was trying to buy a house myself. I would go to a open house and there'd be 50, 60 people there. And the broker would say, unless you're paying all cash, don't even bother making an offer. I mean, it was that crazy. So, we're going to see some air come out of the housing market, I assume, right?
I've been very vocal on the housing market since a couple of months already. So Powell has been saying that he wants, as we said, financial conditions being higher. So rates and credit spreads being higher. Your mortgage rate is nothing else than the sum of the two. How banks make a mortgage, they look at swap rates, let's say treasury yields to make it simple for our audience. And then they overlay a credit spread on that because, Alf is not the treasury. Alf has a credit risk. He can lose his job, maybe can't pay his mortgage. So they'll apply credit spreads on top of that. And the sum of this, risk-free yields and the credit spreads make up for your mortgage rate at the end of the day. And mortgage rates have moved up from 3% to 5%, as you said. Now, a 2% move in mortgage rates, Jonah, might not seem enough. It's huge. And what I say is, let's look at the median house price in America last year. The median house price was $270,000 last year, exactly 1 year ago. Mortgage rates were 2.75%. Third-year mortgage rate fixed, which means that you could basically have a mortgage installment of around about $1,400 a month and buy the median house in America. And you had a median salary.
I'm surprised that's the median house price because I live in the Boston area. You only get a parking spot for that much money.
I know, but that's why I said median and not average. If you say average, then you're going to start putting in New York and Boston and whatever. Then it's not.
Then you're probably $500,000. Yeah.
Yes, exactly. But median is a more unbiased statistics for the median listener in America, perhaps. And so with $1,400, you could buy something, and let's say your salary was $4,000 a month, so something like that, right? Just to make numbers. Now, if you look at how salaries adjusted for inflation are a year later, they're actually lower, not higher, because inflation has eaten away purchasing power. And even if your nominal wage has gone up a bit, it has not compensated for your inflationary pressures.
What are wages up over the last year? 4 or 5%?
I think wages are up over the last year, something like 5% in nominal terms, but inflation is up 7.5%. Right. So I'm sorry, but you're losing, right? So in real terms, when you go and you want to pay your mortgage installment after your food cost, energy costs, and all your CPI basket cost, you find yourself with slightly less real wage than you had a year ago. Now you go check your mortgage installment rate to buy the median house today. So the median house has gone up from $270,000 to something like $300,000. Prices over the last year, median in America, have gone up 10+%. So you end up at $300,000. The mortgage rate is not 3% anymore; it's 5%. Now, if you check your mortgage installment now from $1,400 has gone up to $2,100. That's $700 more, which in percentage is almost 50%.
Right.
And your salary hasn't gone up. In real terms, it's gone down, which means it's much more complicated now to afford the median house with the median salary at the new mortgage rate. It's just almost unaffordable.
Right. And everything, the furniture is more expensive now, the fuel,
Energy,
to heat the house, right. Everything's up. I mean, I know inflation's only up 7, 8, 9% year over year, but most people feel like it's much more than that. I mean, even if if you commute to work every day and you have to fill up your, your tank of gas once a week, and you're paying, last year you were paying $25. Now you're paying $70.
Yeah. And so basically Powell will be achieving what he wants, because if mortgage rates have gone up by all this much, it increases the mortgage installment by 40%, 45%. Salaries haven't gone up, not even 0%, let alone 45%. So to sustain the same house price, it's basically impossible. So it will cool down demand to the point where house prices have to, at least cool off from where they are now, maybe slightly decline. And so people that have this balance sheet wealth effect, because their house price, their implied house price was so high, they now start thinking twice about, well, maybe it's, I need to think twice because my house price is not going to keep appreciating 10% a year. In this period, it's going to slow down. And therefore, the new marginal buyer also will be a bit less buoyant because he can't afford it. And so he hopes to basically dampen down demand. That's his objective via tightening financial conditions, higher borrowing rates, lower equity prices. He wants to slow down demand. That's his objective. And he's been very clear about that. So I think you should listen, you and everybody and I and everybody should listen to what Powell is trying to achieve here, because he has the tools to achieve that.
Do you think mortgage rates are going to level off here?
I think above 5% starts to get difficult to go. I mean, there are two ways you can go above 5% in terms of mortgage rates. Either 30-year bonds in terms of yields, like 30-year treasury yields go up even more from where we are today, or credit spreads widen even more. Now, for credit spreads to widen even more, I mean, it can happen. Like if Powell goes and sells all the mortgage-backed securities he has from the balance sheet very quick, then obviously mortgage rates will take a hit. Don't forget, all these mortgages are repackaged in these mortgage-backed securities and then sold to investors. If you sell all these mortgage-backed securities to investors, all of a sudden, they have less space to attract new mortgage business as well on their balance sheet. And so the new marginal mortgage rate has to be on the margin higher for these guys to be able to absorb this additional risk. But I don't think Powell wants to go ballistic and sell all the MBSs all at once, right?
How much of rates going up right now are investors trying to front run the Fed?
Most of it, I would say. So, I mean, I was a professional bond investor, right? So what we do there is we try to basically price in what the Fed is telling us we should price in, right? So people are like, oh, the Fed hasn't tightened yet. They only hiked once. No. The bond market has already done all the tightening that the Fed has asked or told us to do, which is you front run that. You have these things called Eurodollar futures, where you can basically trade the future outcome a year from now or 6 months from now of where the Fed funds will be, where LIBOR will be, to be precise. But so you can front run that, and this gets immediately reflected, with a lag, reflected into the private sector as well. Because Jonah, if the Federal Reserve is telling you we will hike to 2.5% by the end of the year, you as the bond market will already price it in, which means when you go and borrow already today, even if the Fed hasn't hiked yet, those prices are reflected already in bond yields, which means when the bank is going to lend to you money, they're going to look already at these bond yields already reflecting the Federal Reserve tightening even before it has happened. And they're going to already apply these new borrowing costs, higher borrowing costs to you as the consumer.
So if Powell's saying, you can look at the dot plot that they're going to 2.25%, 2.5% by the end of the year, do you think they actually get there, or will they be able to pull, take their foot off the gas because economic conditions are weakening, maybe inflation starting to roll over and come down, supply chains are, solving themselves, and he can make the threats now, but doesn't have to follow through on it?
No, indeed. So it's $1 million question, and obviously there are two outlier alternatives. One is that he starts and he hikes. He did 25 basis points. He's going to do 50 basis points most likely in May, and then he does maybe another 50 basis point in June. And then by July, we are at maybe 1.5%. All right. So, okay, cool. And then by July, though, things might have changed quite a lot in the economy. As you said, maybe supply bottlenecks start to ease and, the Russia-Ukraine story gets sorted out, the China bottlenecks get sorted out. This is the positive scenario, right? The market the private sector starts to feel the heat of higher borrowing costs. And so, with a quarter of lag, demand has slowed down and also inflation expectations slow down. And the Fed is like, okay, we're probably going to hike all the way to 2% and then just take a breather, because, we are achieving what we want to achieve here, which is for things to slow down. And then maybe market even, they manage somehow because they don't expect the Fed to go all the way through, and really apply very strong heat, but just to massage things through. And then ultimately things are going to hold up together. That's the positive scenario. The negative scenario is that, well, the Fed goes 150 basis points between now and July, which I think is the base case now. Okay. And then no supply bottleneck ease, nothing at all. It can even worsen, by the way, between now and July, you never know. And then inflation isn't coming down, and inflation expectation also isn't coming down. And so what they're going to do, John, is of course they're going to double up. I mean, one of the main power of a central bank and also its main struggle is to retain credibility. If a central bank loses credibility when it comes to their so-called forward guidance, so what they're trying to tell you they will achieve, if they can't achieve that for long enough and the market is actively going against them in terms of monetary policy, that's a serious problem for them.
You think, so maybe for equity investors, best case end of the year is 2% Fed funds, base case 2.5%, worst case 3%?
I think worst case for equity investors is 2.5% Fed funds or above, with inflation expectation not slowing down on top of it, which means you have to imply the Fed will do more. And I think the most important metric, apart from Fed funds, is what they're going to do with their balance sheet. That is so important. Like, what are they going to do with that? Are they going to just make it roll off? At which pace? Are they going to sell bonds from the balance sheet? That's a different game. So you have to be very careful and watch the quantitative tightening announcements too.
Where do you think the inflation expectations over the next 5 years, 3.5%, what do you think is the biggest contributor of that? Is it broken out anywhere?
Unfortunately, it's not. As in, I can derive this 3.5% from basically these instruments that have as underlying CPI, and CPI is the headline CPI. So it includes the whole bunch, from the core elements to the more volatile food, tobacco, whatever, oil. It includes the whole bunch of it.
So it's hard to know exactly what's driving those expectations.
Well, you can do, I haven't done the study, but thinking out loud with you can do some analysis looking at forward oil prices. So you look at the oil price future, not today, but 3 year forward, 4 year forward, and you see what they're pricing in, basically, because traders will inform their view on inflation swaps also looking at oil, which is a large contributor of inflation. I haven't done the study, to be honest, Jonas, so okay. I'll have to do some homework and be back to you.
Well, it's just hard. I mean, because there's just right now there's so many elements that are impacting the supply chain and inflation, and obviously a lot of it is Ukraine and Russia, and we don't know how long that's going to last. And if that actually ends soon, do the sanctions come off? And so, I mean, just a lot of question marks around all of that. What else would you like to talk about?
You asked me before about my portfolio, and I, being a former risk taker, I still running my own money. I am very public on my Twitter account @MacroAlf. About my trades. I have nothing to hide. I'm gonna, publish my portfolio and updates from time to time, including where I'm wrong, and I'm often wrong, as everybody is. So the positions I'm running today are basically two. I am short an ETF in the US, which is called LQDH. So it's the LQD, the famous investment grade corporate bond ETF, but LQDH, which is an interest rate hedged version of that ETF, which means you're not going to trade corporate bond yields, you're going to trade corporate bond spreads. So only the credit spreads of corporate bonds. And I think those can suffer in this environment because all these companies are, generally speaking, pretty high leveraged in the US. I mean, there are other jurisdictions where they are even more leveraged, but in the US, we're not kidding there. And all this leverage, Jonah, has to be refinanced with earnings and the economy slowing down, with the Fed very keen in making demand even slow down further. And as interest rates are going up, borrowing costs are going to become more expensive.
So do you think the yields on high quality bonds and low quality bonds are going to spread?
Yeah, I mean, the spread. So the spread between these yields and the treasury yields, I think this is going to widen. So basically, corporates are going to be priced to be more of a risky business than they were a year ago. That's what I'm going for. I'm shorting this LQDH ETF. You can buy puts on it. You can just short it if you have a broker that allows you to short it. And I think this is a place of the market that hasn't repriced yet. I mean, equity markets have repriced a bit.
Right.
Rates have gone up. And credit spreads have widened, but I think there is more to go there.
Because junk bond yields got pretty low about a year and a half ago when everyone was chasing yield, right?
Well, think about it, Jonah. It's the same story of you going to buy a house and finding 20 people in there. When borrowing is so cheap and when the Federal Reserve is telling you, go for it, guys, there is nothing to worry, I got your back, then obviously, and your wealth effect is growing month by month by month, you will feel always more incentivized to go after new deals, right? And so you're going to buy junk bonds, you're going to buy anything you can in order to make sure you get some yield, you get some returns, right? It's a typical animal spirit sort of economy. That was the 2021, and now it's a completely different game. The Federal Reserve is telling you, animal spirits, I don't want that. You guys should calm down. I think the situation is getting out of control. And so in this environment, the trades you do are not the offensive trade, are not the risk-taking trade, are the more defensive trade. You look for stuff that you can actually short, or if you have to be long, you are long stuff with a strong balance sheet. You don't go long the highly levered businesses. You don't go long the stuff that has projected cash flows 20 years from now. You look for solid businesses, low beta stuff, consumer staples, utilities, pharma, that kind of more conservative. Although also these guys will suffer, don't get me wrong, but they will probably suffer a bit less. Question I see in the chat. The Twitter handle is @macroalf.
Now, do you own any? You said you had two positions, so I'm assuming you don't own any equities right now.
Oh, no. Let me clarify that. So I have two portfolios. One is a long-term portfolio, and the one I'm talking about is a tactical trading portfolio, basically.
I gotcha. Okay.
It has a time horizon of a month minimum. So I own trades for generally a month and a half. So it's not a daily trading exercise, but it's a much more active one. So okay. I go long, short stuff. The two trades there are short LQDH. And then in Europe, I shorted Italian government bonds and I bought German government bonds. And that is the same story where Italy is a much weaker country than Germany. And so if conditions become much tighter, then Italy suffers more. It's a similar expression with a different geography, basically.
So, I mean, most of the people watching this are probably in the US.
Yeah.
So a lot of us aren't in tune with what's going on in Europe right now. I mean, obviously we know there's a war. We know that, natural gas prices over there have spiked. I know inflation is high. Is it similar over there as it is in the US?
So it's a weird situation. So you asked me, what about wages in America? Remember, I told you 5% up in nominal terms and inflation 7.5% up. Well, in Europe, in nominal terms, they went up a meager 2% and inflation went up 5%.
Okay.
So the consumers are even more squeezed. Europe is even more energy reliant on Russia, for example. So we even have a worse situation when it comes to the squeezes on real personal income. Europe is even more acute. And actually, if I look at some of my forward-looking indicators, they tell me that we're probably going to go through a very sharp slowdown, perhaps even a recession in Europe this year already. So the situation is more complicated already from the demand side, but inflation is running at 5+% in Europe as well. In the Netherlands, last print was 12%.
Really? Wow.
So then the heat is growing on the European Central Bank, which has interest rates at minus 0.5% still, to try and speed up stuff, right? And they are. And so also the bond market in Europe is starting to reprice as well. And it's the same story, as I said before, in the US. It's basically also applicable somehow in Europe.
Holy smokes. Yeah. I mean, it's a global problem. I mean, because the whole world depends so much on energy. And I mean, if energy costs are going to go up by 100 or 150% year over year, just an absolute mess. I mean, the more data, I saw a farmer on Twitter the other day talking about how I think he said, I might get these numbers wrong. I thought he said it cost him $200 or $300 to fertilize an acre last year, and now it's like $1,000 to fertilize an acre. I don't know how that's not going to just spike food prices over the next 6 to 12 months.
Yeah, I am honestly afraid that the situation might get better. There is a chance that all these geopolitical tensions sort of fade away, and also the China zero COVID policy actually, gets sorted out somehow. The problem is it's going to take time. It's going to take quarters until you can restore decent supply chains at decent prices, at decent speed. And some permanent damage, unfortunately, has been done when it comes to trusting trade partners, to having these on-time supply chains. Well, these on-time supply chains don't really work anymore, do they? And so a lot of countries might think that medium term is better to insource some of this production rather than to outsource it and be dependent on this globalized trade supply chain that can easily break up. And when you insource, obviously, you increase barriers, you trade less. So inflation might perhaps be a bit higher than it was over the last decade. But what people don't tend to look at is that growth is going to be slower. Growth is likely to be slower because you do things in a much less productive way. You do things, in a more closed environment rather than opening up to make sure that you have good interactions with other country. So, we have already a declining labor force, basically all over the world. If you look at Chinese labor force, I wrote an article on the Macro Compass, which is my free newsletter, Jonah, and I looked at what Chinese labor force is going to look like in 20 years from now. The Chinese labor force went up from 700 million to 1 billion between 1980s and 2010 in 30 years. That's a lot more people working. Obviously, they produce output and the Chinese economy grows. But between 2020 and 2050, it's going to go back down to 700 million.
Really? Why? Because of technology?
No, it's a mix of the two. But actually, the most important reason is that the Chinese population is aging. So people are going to retire. And the one-child policy has made sure there is no replacement for these guys.
Right.
So the guys are retiring, and where are the new kids joining the labor force? They're not enough.
Do they still have a one-child policy?
They now scrapped it, but it's too late. It's going to take decades until they're able to get back to a decent level of fertility rates.
Wow.
And in the meantime, the population will be aging. There are not enough new kids entering the labor force, and China doesn't do any net immigration from the outside, right?
Right.
So you have this declining labor force trends, and then you want to start doing all these deglobalization sort of policies. You want to insource stuff. Then yes, inflation has to be repriced a bit higher. But what about growth? Growth has to be repriced lower in this environment. And so we are facing this global macro crossroads where I think it's truly interesting at this stage.
Now, the definition of a recession is sequential quarters of negative GDP, correct?
Correct.
And historically, or at least over the last 10 instances when the yield curve inverted, I think 2-year, 10-year, it's always led to a recession.
Yeah.
Do you think we're going to end up with a technical recession this time around too?
I get this question a lot
of course.
of late on podcasts. So the answer is I don't know. But the only thing I know with a certain base case certainty is that we are going to go through a sharp economic slowdown. Sharper, I believe, or my models are telling me, than what economists are pricing in by now. Are we going to hit the point where GDP growth is going to be quarter on quarter minus 0.1 and minus 0.1? So we can collab it a recession.
Right.
I don't know. I only know that markets are going to care about the trend and the path and the impulse of this slowdown. And if we get to GDP growth, which is 0%, Jonah, rather than negative 0.1%, it's going to be as bad for markets as it is hitting a recession with between brackets. I know it sells a lot on Twitter and on paid services to go out and scream there's going to be a recession. When it comes to risk taking and to markets, what we care about is the direction of growth and the pace of change.
Right.
And here I believe the direction is going to go down and the pace of change is going to be sharper than what's priced in. So you have to be more defensive allocating your assets.
And there's so many people on both sides of the fence. I mean, I can watch CNBC and one guest says that he thinks EPS earnings this year will be higher than expected. Another, the next guest will say, he thinks EPS will be lower than expected. So, I mean, nobody really knows. And there's just so many factors pulling on both sides of the string. So it's interesting to watch. I mean, what sort of equities do you own in your long-term portfolio?
Oh, the long-term portfolio is just a risk premium harvesting portfolio. So what I do there is I just buy low-cost ETF and I just own it. Okay. I buy, equities, bonds, Bitcoin, and gold. Those are the 4 asset classes that I just own there in different percentages because I have a certain risk appetite, I have a certain age. And I know it sounds really unsophisticated, but guys, the reality is that if I look at the US financial assets market cap divided by GDP, from the 80s to now, it has gone up from 2 times to 6 times. It's huge. And do you know why? Because every time this goes up, your wealth effect is higher. You feel you're wealthier. You want to spend more. If we can't grow the economy via GDP growth because we're an aging population, because technology is advancing, because our productivity levels are what they are, and we are not making enough kids at the same time, then we're going to try and feel more wealthy via wealth effect. And the wealth effect basically sort of forces asset classes to go up over time. And when you want to try and remove that wealth effect, it's a catastrophe because you go back to your structural GDP trends. They're very bad. And there is no politicians out there that wants to grow at 1% GDP a year. I mean, that's not palatable. So for the long term, I know that I have to be coherent and participate into this wealth effect game, basically, while at the same time owning some assets that can protect me against, well, these resets sort of things that you see a lot on YouTube. But honestly, you can't really predict when it's going to happen and to which extent. So you might want to have a certain percentage of your portfolio that is able to at least protect your purchasing power if you start to go towards this crossroads where this kick the can down the road wealth effect system doesn't really work anymore. So I find this balance to be very palatable for me long-term, Jonah, because I can just harvest the returns, maybe not every single year, but this is a portfolio I want to keep there for a long time, make sure I can, be invested in the market. And then I have another tactical portfolio where I'm like, okay, what's going to happen over the next 3 months or 6 months?
Right.
And there I try to be more opportunistic about it.
So last question. So someone asked, and I this is going to kind of put you on the spot. I have my own opinions on it, sure. But they asked, what do you think are the chances that China invades Taiwan?
Ooh, I have no edge. I have no edge to answer this question.
My thought is after China watched the severe sanctions put on Russia, if they were thinking about invading Taiwan, that has to make them think twice about it.
I tend to lean your way, but honestly, we can only speculate. I mean, China is a place where the information asymmetry we have here from the West is massive compared to what's in the head of Xi Jinping's or of Putin from that perspective.
Right.
So honestly, we can only speculate. But I learned through my career, Jonah, that there are certain things that will always remain unknown unknowns. And it's completely fine to say, look, I don't know. I can speculate. I can give you my opinion, but it's not backed by facts or by an informational edge. So, sorry, guys, I don't know.
I agree. Yeah. Like I said, that was going to be a tough one. I think I covered everything.
Yeah, I got to run, Jonah. So do you have any closing things?
FOMC minutes come out today at 2:00. I mean,
watch for quantitative tightening, let's say, comments by FOMC members. I'm going to release a thread 90% because every time there's a fixed income thing, people go nuts. And I've traded this with billions until a few months ago. So I know how to read in the weeds, and I'm going to try to give you guys a service and put out a free thread. Everything I do is free anyway. A thread on Twitter or an article on the Macro Compass trying to cover what's going to happen with the Federal Reserve balance sheet so that you can focus on the right things without getting lost in this, clickbaity headlines you're going to be reading over tonight. So I'm going to do my best as always.
Awesome. Well, I appreciate you coming on. Great talk, great chatting with you. And, let's do it again in 6 months or so.
I would love so. And for people, I mean, if you guys want to find more Twitter, and my newsletter, The Macro Compass, on Substack, all free. And you can read all this, macro insights and this learning journey I'm trying to share with you, basically.
Yeah, and I'll put those links in the.
Oh, thanks.
When I do the email blast and then I put it on YouTube, I'll include the links.
Appreciate it. And remember to invite me to the next FinTwit conference. I'm going to try and be there.
I will. Thank you, man. Talk to you soon.
Ciao.